While markets were distracted by rate cuts, elections, and AI headlines, something structural shifted in the background. Industrial buyers began paying 20–40% above quoted market prices for critical raw materials. Not for speculative reasons, not for inventory padding. They are paying up because the price on the screen no longer guarantees delivery in the real world. That single sentence defines the problem. The paper market is still trading. The physical market is rationing. This is not a story about a sudden shortage that shows up in a headline. It is a story about a delivery failure, a gap between financial price discovery and physical availability. The crowd misses it because most people interact with commodities through charts, ETFs, and futures quotes. Those systems still function. Trades clear, prices update, volumes print. On the surface, nothing looks broken. But underneath, procurement desks at battery plants, electronics manufacturers, solar fabricators, and defense contractors are learning a new rule. The posted price is no longer the price that secures metal. The real clearing price is the one that convinces a warehouse, refiner, or fabricator to part with inventory today instead of next quarter. In some markets, that premium is already visible. Depending on region and contract size, industrial buyers report paying 10–25% above spot for base metals and 20–40% above futures-linked pricing for specialty grades, high-purity material, or guaranteed delivery windows. These are not retail markups. These are inter-industry transfers, manufacturer to manufacturer, where failure to source inputs halts production lines worth millions per day. Why is this happening now? The forcing mechanism is inventory exhaustion colliding with a financialized supply chain. Over the last decade, just-in-time logistics compressed buffers. At the same time, derivatives markets expanded, allowing producers, traders, and consumers to hedge years forward. The system assumed that if paper claims cleared, physical flows would follow. That assumption only holds when inventories are thick. When visible stocks fall below a critical threshold, often estimated at 6 to 10 weeks of industrial demand, the system flips. Futures still trade, but physical holders gain pricing power. Warehouses stop behaving like neutral pass-through nodes and start acting like option writers. Every ton held becomes a strategic asset. Delivery terms tighten, lead times stretch from days to months. Optionality acquires a price. Now here's where it breaks. Paper markets price abundance. They assume fungibility, rollover, and netting. Physical markets price scarcity. They price time, purity, location, and reliability. When those two frameworks diverge, the screen lies. Not maliciously, but structurally. The stakes are larger than a commodity chart. Inputs like copper, silver, lithium, nickel, aluminum, and specialty alloys sit at the core of electrification, defense, and industrial automation. A 30% input shock propagates through supply chains as margin compression, price hikes, and production delays. That feeds directly into CPI, PPI, and capital expenditure plans. It becomes macro. This analysis is for educational purposes only. It is not financial advice. Markets involve risk, uncertainty, and nonlinear outcomes. Consult qualified professionals before making any financial decisions. Most observers still think of commodities as cyclical. Supply rises, price falls, price rises, supply follows. But this episode is not cyclical. It is structural. It is about what happens when a paper system built for liquidity collides with a physical system constrained by geology, refining capacity, and time. To understand why industrial buyers are paying 40% more than the market price, you have to separate two systems that most people assume are the same. They are not. There is the paper system, futures, forwards, swaps, ETFs, and hedging contracts. This is where price discovery appears to happen. It is liquid, continuous, and nettable. A copper contract can change hands 50 times without a single cathode moving. Risk is transferred, not material. Then there is the physical system, mines, smelters, refiners, warehouses, trucking lanes, ports, and factories. This system moves atoms. It has bottlenecks. It has lead times. It cannot be rolled at expiry. Under normal conditions, these systems are tightly coupled. Futures prices guide production. Producers hedge forward. Consumers lock in costs. Warehouses act as buffers. If a factory needs 1,000 tons, it buys through a trader who sources from inventory or a nearby smelter. The paper price anchors the transaction. That coupling depends on one variable, excess inventory. When visible stocks sit at, say, 20–30 weeks of consumption, no one has leverage. If one holder refuses to sell, another will. The futures price clears both markets. But when stocks fall toward the operational minimum, often estimated between 6 and 10 weeks of demand, the system flips. Let's make this concrete. Assume a metal with global industrial demand of 25 million tons per year. That is roughly 480,000 tons per week. If combined exchange and bonded warehouse stocks total 12 million tons, the system holds about 25 weeks of buffer. Abundant. No urgency. Now compress that buffer to 3 million tons. That is just over 6 weeks. At that point, every holder knows two things. If deliveries hiccup, weather, labor action, refinery outage, there is no slack. Any buyer who fails to secure material risks shutting down downstream production. This transforms inventory into a real option. The holder is no longer selling metal. They are selling time insurance. Paper markets cannot price this well because futures assume substitution across time. If a contract expires, you roll. If delivery is tight, you cash settle or defer. But an industrial buyer cannot roll a halted assembly line. A battery plant burning $25 million per day in fixed costs cannot wait 60 days for a shipment. So the buyer does something rational. They step outside the paper system. They call a refiner, a warehouse operator, or a fabricator with inventory. They offer a premium for immediate, guaranteed delivery. That premium reflects the cost of failure. If the plant loses $3 million per day and a delay risks 10 days, the implied economic exposure is $30 million. Paying an extra $3,000 per ton on a 5,000-ton order, a 30% premium on a $10,000 base price, is not expensive. It is cheap insurance. This is the part most people miss. The premium is not about speculation. It is about option value under constraint. Futures curves begin to show this stress first through backwardation. When near-term contracts trade above deferred ones by 3-8% annualized, it signals that immediate material is more valuable than future promises. But backwardation alone is still paper. The real break occurs when warehouse available stocks fall faster than total stocks. Delivery times stretch from days to weeks, then months. Minimum order sizes rise. Fabricators refuse spot quotes and demand long-term offtake. At that point, the posted price becomes a reference, not a clearing level. Industrial buyers are effectively saying, your screen price buys exposure. My problem requires atoms. And atoms have friction. Every structural market break eventually becomes a story about who cannot wait. Scarcity alone does not create crisis. Deadlines do. In this environment, the most exposed actors are not speculators. They are industrial consumers whose business models assume continuous throughput: battery manufacturers, semiconductor fabs, automotive supply chains, grid infrastructure contractors, defense primes, and electronics assemblers. These firms operate on tight production schedules, capital-intensive lines, and long customer commitments. A single missing input, one alloy, one refined metal, one specialty component, can idle an entire facility. Their constraint is binary. Either material arrives or revenue stops. A lithium processor may carry $1 to $2 billion in annual fixed cost. A solar module plant can burn $500,000 per day while idle. An EV assembly line may lose $2 to $4 million per day in gross margin if halted. Against that math, paying a 20-40% premium on a feedstock that represents 5-15% of unit cost is not aggressive. It is survival. On the other side sit the inventory gatekeepers, miners with uncommitted output, refiners with buffer stock, traders with bonded warehouse access, and fabricators holding intermediate forms. These actors face no daily burn rate. Their asset appreciates under scarcity. Time works in their favor. They are not villains. They are rational. The system now confronts a coordination problem. The paper market still clears at a price reflecting average conditions, but physical holders price for worst-case conditions. They know that if they release inventory today, replacing it may take 60 to 120 days. During that window, any disruption exposes them to replacement risk at unknown prices. So they raise terms, higher minimum order sizes to reduce transaction friction, longer lead times to preserve optionality, premiums for immediate allocation, preference for long-term offtake over spot sales. This forces buyers into a corner. Either they pay up now and secure continuity, or risk production gaps with cascading penalties. There is no third path. This is why the pressure concentrates in industry, not finance. A hedge fund can roll a futures position. A factory cannot roll a missing component. Banks and market makers are also trapped, but differently. They intermediate between paper and physical. Many have written delivery options implicitly through inventory financing, lease agreements, or structured supply contracts. As physical availability tightens, their hedges degrade. A future short no longer guarantees replacement metal. The basis widens. The hedge becomes theoretical. That is when balance sheets enter. If a bank finances 100,000 tons of inventory at a 5% annual carry, it expects to source replacement metal at roughly the futures price plus storage. But if replacement now costs 30% more in the spot physical market, the embedded optionality becomes a liability. Risk models built on historical correlations fail. The institution must either raise margins, curtail credit, or withdraw from physical facilitation. Liquidity contracts. Now add policy. Governments increasingly classify metals as strategic. Export controls, local content rules, and stockpiling mandates change incentives. A producer may prefer selling domestically at a controlled margin rather than exporting into uncertainty. That further fragments the global pool. This creates a chain of forced behavior. Manufacturers front-load procurement, traders hoard buffer inventory, banks tighten financing, producers prioritize contractual buyers, spot availability collapses. The system becomes reflexive. Each attempt to secure supply reduces free float, which raises the premium, which validates the fear. History offers a parallel, the nickel squeeze of 2022. Exchange prices functioned until a short position collided with physical reality. When deliverable inventory proved insufficient, the market halted. The lesson was not about one metal. It was about what happens when leverage meets scarcity. The difference now is scale. This pattern is emerging simultaneously across multiple industrial inputs. It is not a corner. It is a regime shift. Either physical markets rethicken through new supply, slower demand, or coordinated release, or paper prices must rise to ration use. Those are the only equilibria. When a market shifts from abundance to constraint, opinion stops mattering. The balance sheet takes over. Every industrial commodity obeys the same identity. Available supply, production, plus recycled flow, plus inventory. Drawdown demand, however, is mostly inelastic in the short run. A grid upgrade does not pause because copper is expensive. A defense contract does not delay because alloy spreads widened. A battery plant does not idle voluntarily. These are capital structures measured in billions, not optional purchases. That means price is not set at the margin of want. It is set at the margin of can wait. Let's construct a generic industrial metal scenario using conservative labeled ranges. Assume global annual demand 28 million tons, weekly demand 460,000, 540,000 tons, new mine plus refined supply growth 1.5, 2.5%, annually inventory buffer, exchange plus bonded plus commercial. 6 to 10 weeks. At the midpoint, the system holds roughly 3 to 5 million tons of accessible stock. Now introduce 3 real-world frictions. Refining bottlenecks, concentrate, does not equal metal. Smelting and refining capacity often grows at less than 1% per year. A mine opening does not instantly convert to deliverable form. Geographic fragmentation. A ton in Asia does not solve a shortage in Europe without weeks of transit and financing. Grade specificity. Not all material is interchangeable. EV cathodes, aerospace alloys, and electronics demand purity bands that exclude much of the stockpile. If just 15-20% of reported inventory is unusable for a given application, the effective buffer shrinks to 2.5 to 4 million tons. That is 4 to 7 weeks of demand. Now run 3 scenarios. Scenario A, tight but stable. Supply growth, 2.5% demand growth, 2.0% net balance, 0.5% annual surplus. Hire 120,000 tons. Weekly surplus, 2,300 tons. At this pace, it takes an entire year to rebuild even 1 week of buffer. Any disruption, a strike removing 200,000 tons, a smelter outage of 100,000, wipes out months of progress. Physical premiums remain elevated because replacement risk persists. Scenario B, structural deficit. Supply growth, 1.5%, demand growth, 3.0%, net deficit, 1.5%, annual shortfall, 360,000 tons, weekly shortfall, not 7,000 tons. Here, inventory is drained by more than 1 week per year. After 3 years, a 7-week buffer becomes 4. Every holder understands the glide path. The rational move is to hoard optionality. Premiums rise non-linearly as the cliff approaches. Scenario C, shock regime. A 5 to 8% supply disruption from geopolitics, weather, or regulation, equivalent to 1.2, 2.0 million tons removed. That is 3 to 4 weeks of global consumption. In this regime, the paper market still prints. Futures may move 10 to 15%, but the physical market reprices in discontinuous jumps. A buyer facing a 30-day outage risk values certainty more than price. A 40% premium becomes rational. This is why traditional valuation frameworks fail. Paper markets assume marginal flow sets price. Physical markets under constraint are set by replacement risk. The relevant question becomes, if I sell this ton today, What is the probability I cannot replace it when I need it? That probability rises sharply as buffer falls below 8 weeks. It accelerates below 6. It becomes dominant below 4. At that point, inventory ceases to be working capital and becomes strategic reserve. This is observable in the data. Exchange stocks trending downward despite flat prices, available for delivery categories shrinking faster than total stocks. Backwardation, steepening beyond 5 to 8%, annualized regional premiums diverging by 15-40%. Lead times extending from days to months. The paper price still reflects the average. The physical premium reflects the marginal. When a physical market detaches from its paper anchor, the reaction does not look orderly. It looks irrational to anyone watching only the screen. Prices gap, correlations break. Liquidity vanishes at the exact moment it is needed. Spreads widen, not because sentiment changed, but because the cost of certainty reprices. This is the transmission mechanism. First, basis risk explodes. The spread between futures and physical widens beyond historical norms, 5%, then 10%, then 20% in certain regions and grades. Traders who rely on convergence discover that convergence is conditional. If delivery cannot be sourced, the hedge fails. Market makers step back. Quoted depth thins. A 1% order moves price 3 to 4%. Second, volatility feeds itself. As near-term contracts trade at a premium, backwardation, inventory holders are paid to sell today rather than tomorrow, but they also face replacement risk. Many choose to withhold. That reduces visible supply, which steepens backwardation further. The curve becomes a billboard advertising scarcity. Third, financing tightens. Banks and commodity finance desks respond to rising basis risk by increasing margins, shortening tenors, and reducing inventory-backed credit. A warehouse that once financed 80% of value may now finance 50, 60%. That forces traders to shrink books. Shrinking books reduce liquidity. Reduced liquidity amplifies price moves. The loop closes. Fourth, forced behavior emerges in unexpected places. Downstream manufacturers begin to prepay. Governments intervene with stockpiles and export controls. Producers reroute material toward contract buyers. Spot markets become thin, then episodic. You see prints that look like errors. Single trades 12% above the prior tick. They are not errors. They are scarcity clearing. Observers misread this as speculation. It is not. It is the price of guarantee. This is why the reaction feels chaotic. Paper markets are built to net risk across thousands of participants. Physical markets cannot net a missing ton. They must source it. When those logics collide, price becomes discontinuous. You saw this in Europe's gas market in 2022. The TTF benchmark printed $300 mid-dollars, while long-term contracts still cleared far lower. Utilities paid multiples because the alternative was blackout. You saw it in base metals during pandemic logistics shocks. You saw it in nickel when deliverable inventory could not cover obligations. Each time, the screen lagged the dock. What should observers watch? Not the headline price alone. Watch the plumbing, physical premiums by region and grade. When Rotterdam trades 18% over LME and Midwest trades 30% over, the market is fragmenting. Backwardation in the front months. Sustained 5-10% annualized signals immediate scarcity. Spikes above that indicate stress. Warehouse available stocks versus total stocks. When available falls faster, holders are reserving metal, delivery notices, and cancellations. Rising deferrals mean paper obligations are being renegotiated. ETF creation redemption behavior. Large redemptions into tight physical markets drain float. Large creations fail when sourcing is hard. Credit spreads in commodity finance. When spreads widen 100, 300 basis points, liquidity is retreating. These indicators move before price does. The reaction may look like manipulation or panic. Structurally, it is neither. It is a system repricing the cost of time under constraint. One more feedback loop matters. Substitution failure. In abundant regimes, demand responds to price. Users substitute aluminum for copper, change designs, delay projects. Under constraint, substitution lags. Redesigning a product takes quarters. Recertifying materials can take years. In the short run, demand is rigid. Price must do the work. That is why the first leg is premium, not volume. Buyers pay up rather than stop. Only later, when projects are canceled and capex deferred, does demand adjust. The market overshoots because it must force behavior that is slow by nature. This is also why interventions often backfire. Price caps, export bans, and release announcements may suppress screens temporarily. They do not create atoms. They often reduce available float, intensifying the premium elsewhere. The paper system transmits the shock through volatility. The physical system transmits it through delay. Both are logical. They are just optimized for different worlds. Once a market begins pricing time instead of abundance, the path forward becomes constrained. The system can only rebalance through three channels: new supply, reduced demand, or structural intervention. Everything else is noise. The timeline usually unfolds in layers. Next, 24 to 72 hours. Paper markets remain functional. Volatility rises. Spreads widen. Physical premiums move quietly through private contracts. Most participants still believe this is temporary. Next 1 to 4 weeks, lead times extend, minimum order sizes rise, financing terms tighten, backwardation steepens, procurement desks escalate internally. The story moves from traders to CFOs. Next 1-2 quarters, either supply thickens, demand cracks, or the system formalizes scarcity through higher benchmark prices. This is where regimes change. From here, 3 scenarios dominate. 1. Base case. Persistent tightness. Supply grows slowly. Demand remains resilient. No major shock, no major relief. Physical premiums stabilize in a 10-25% range. Backwardation persists at 4 to 8% annualized. Inventories grind lower or flatline at 5 to 7 weeks of demand. Paper prices trend upward in steps, lagging physical reality. This is the most likely outcome in a world where electrification, defense spending, and infrastructure remain priorities while new capacity takes years. Confirming indicators: exchange available stocks stop falling, but do not rebuild. Regional premiums remain elevated without collapsing. Front-month spreads stay inverted across multiple contract cycles. Long-term offtake agreements increase in volume and duration. Commodity finance spreads widen modestly, 50-150 BPs, and stay there. In this regime, the market does not break. It hardens. Time becomes expensive. The paper system adapts upward. 2. Stress case. Constraint becomes crisis. A shock hits. Geopolitics, weather, regulatory action, or a major plant outage. The thin buffer fails. Physical premiums spike to 30 to 60% in affected regions. Spot availability disappears for weeks. Futures gap violently. Correlation with equities breaks. Governments intervene. Export controls, stockpile releases, emergency procurement. This is where headlines finally catch up. Confirming indicators: sudden inventory drops of 10 to 20% in a single reporting cycle. Front-month spreads blow out beyond historical bounds. Delivery deferrals and cash settlements rise. Policy statements referencing strategic materials, downstream production halts, or public guidance cuts. Here, the paper system is forced to reprice in discontinuous moves. What looked like a premium problem becomes a macro problem, feeding inflation, disrupting output, and tightening financial conditions. 3. Relief case. Rethickening the system. Stability returns only if one of 3 things happens. New supply comes online faster than expected. Demand weakens materially. Recession, project cancellations. Coordinated release or substitution expands effective inventory. Premiums compress back towards single digits. Backwardation flattens. Lead times normalize. Inventories rebuild toward 10-12 weeks of demand. This scenario requires real atoms, not rhetoric. Confirming indicators: sustained weekly inventory builds across multiple regions, narrowing of regional premiums below 5 to 8%, forward curves flattening or shifting into mild contango, declines in industrial order books, rising scrap and recycling flows. Relief is slow, it compounds. It is visible in tonnage, not commentary. The deeper takeaway is structural. Modern markets are built on the assumption that financial liquidity can substitute for physical slack. That works when buffers are thick. It fails when systems are optimized too tightly. What you are watching is not a commodity story, it is a market structure story. Paper systems are extraordinary at redistributing risk. They are poor at manufacturing atoms. When the real economy presses against physical limits, price discovery migrates from screens to loading docks. Premiums emerge not as speculation, but as the cost of certainty. Futures stop leading. They follow. This does not mean collapse, it means regime change. In one regime, price clears marginal demand. In the other, price rations time. We are crossing that line. This content is for educational purposes only. It is not financial advice. Markets involve risk, uncertainty, and non-linear outcomes. Consult qualified professionals before making any financial decisions.